Hey, Chapter 2, Introduction in Managerial Accounting, Chapter 2. Now, today I'm going to talk about some cost terms, concepts, and classifications. Now, we're going to start digging into the cost of the company and try to find what cost is what and how can we use that cost for our purposes. First one is let's go to make some products. In the manufacturing company, we're going to come a little bit later to the type of the company. In the manufacturing company, we have to produce, objective is to produce the product. Now that product that we want to produce is going to have a cost. The cost for that product is going to come from three components, three main costs. Classification. One we'll call direct material. The other will be direct labor. And the third one is going to be manufacturing overhead. So let's see what each of those is. Direct material. From where direct material is going to come? Direct material represents any raw material that we previously purchased, which we want to convert into the product. Now, there will be raw material that we can still convert to the product, but they won't be treated as a direct material. So then which raw material is going to be treated as a part of the direct material? That will be the only raw material that we can easily trace directly to the product, and they become integral part of that product. So everything that you're seeing on this, I believe it's Ferrari, muffler and front hoods, the doors, that will be a raw material. That metal doors everywhere, not plastic, because that's an old car. Everything is metal. Everything will be the direct material here. Direct labor. Direct labor will be, again, another cost, the second cost that comes in the product. And that will be the labor or cost of the people which working on the product, which can be easily traced directly to the individual product. So which one comes first? Always direct material comes first. Why is that? Because we need workers to work on something. If they don't have the raw material, there's nothing for them to work. Even if we have a labor, we still need the raw material. So that's why, for that reason, the direct material always comes first. Direct labor comes second. And then we have manufacturing overhead. Manufacturing overhead is, again, we're going to have a raw material, we're going to have a labor, but those cannot be easily traced to specific unit or specific product that we're producing. For that reason, we're going to call it indirect cost, and we're going to combine that cost all together. We're going to assign it to, later on, we're going to see in chapter 6, how exactly we're going to assign that cost. Chapter 5, actually, how we're going to assign that cost to the product. Wages of the employee, which are not directly involved in production, that will be our indirect labor, and materials which are support the product process, but are not integral part and cannot be easily traced to the product. Those will be our indirect materials. Also, we're going to have some other costs related to the main production line, which can be rent, could be security, can be depreciation of the machinery that we're using for the production. All that will be captured under the manufacturing overhead. For that reason, now we like the classification in accounting. We always want to classify, and we like to put terms on something. So once we put the terms on the product cost, and we come up with the product that the product has direct material, direct labor, and manufacturing overhead. Now let's do another classification, which will be direct material and direct labor. We're going to call it prime cost. Prime, as you probably guessing from the Latin word prime, means first. So those will be the cost that first comes in the product. Direct material definitely comes first, direct labor comes second, but it's still on the category, the first coming first. So that's why direct material, direct labor always going to be called prime cost. Now, direct labor, manufacturing overhead, those two together, it's going to be called conversion cost. Why? Because direct labor and manufacturing overhead convert raw material or direct material into the product, which later we're going to call it finished goods. That's why direct labor and manufacturing overhead is called conversion cost. They converting something into a product, because direct material itself is nothing, it's just material. Now we have to make a product, which we're going to sell to the client. How are we going to treat the overtime? I believe I showed you last time with overtime and ideas with the overtime with additional information about the BC Employment Standard Act. Now, in the managerial accounting, in the accounting process, we're going to treat overtime as a direct labor cost. That's with the product cost. What other costs we're going to have? We're going to have period cost or non-manufacturing cost. Non-manufacturing costs will be the one that support the production, but it's not involved anything with the production. I mean, support business, but it are not directly involved in the production, which is marketing and selling cost. Now, they help the business to sell the product, but they're not part of the manufacturing process. Administrative cost, those will be the organizational cost, clerical cost, accounting cost. They're going to help us to understand the business and to understand to prepare the reports. But again, they're not part of the production line. So what we're going to do, we're going to have those two types of costs. One's called product cost, and the other one will be period cost. Now, if we have to go back to the financial statements, we have a financial statement which is prepared for the period of time, and that's an income statement. So the period costs, they're going to be called directly to the income statement as an expense, where the product cost, for the time being, is going to stay on the balance sheet. We're going to put the direct material, direct labor, manufacturing overhead into the product cost or inventorable cost. That's how it's also called, inventorable cost. And we're going to keep it on the balance sheet until the client comes and say, I want this product. Once the client says, I want this product, since the product comes with cost and we're selling that product, the cost of the product will become cost of goods sold. Why is cost of goods sold? Because the product that we sold, we manufacture it, that has direct material, direct labor, manufacturing overhead, comes with cost, and we sold it. Now, which of the following will be considered period rather than product cost in the manufacturing company? First one, now the idea here is every time when you see manufacturing, production, anything related to the main product, which the company producing, that always and always gonna be manufacturing cost or product cost. If it's not related to the manufacturing or production, it's gonna be period cost. Let's go with the first one, manufacturing equipment depreciation. What do you think? Product or period cost? Product cost. If it's from the product cost, since we know the product has direct material, direct labor, manufacturing overhead, which one will be manufacturing equipment depreciation? Is it going to be direct material? It's depreciation, so it's going to be manufacturing overhead, correct? Let's see with the second one, property taxes on the corporate headquarters. Is that related to the product? And what kind of cost will be? Period or product cost? That will be period cost, yes. How about direct material cost? Product cost. What kind of product cost is that? Direct material, direct labor, manufacturer overhead? Obviously, it says in the description, direct material. Next one, electrical cost to light the production facility. Yeah, it's going to be product cost. What kind of product cost will be that? Direct material, direct labor, manufacturer overhead. Manufacturer overhead, correct. Tina, you're very fast. Good job. How about sales commissions? Period cost. Yes, that's correct. Sales commission will be period cost. Good job. Let's see yes, only the property tax at corporate headquarters and sales commission will be the period cost. Everything else will be product cost. Now let's see what kind of businesses we have in North America. Technically, we have three types of businesses, not four, three. One is called sales. One is called service. The other business is called merchandising business. And the last one is manufacturing business. Now, in the service business, the whole thing is which business we're going to have inventory and we're going to have the goods. In the service business, yes, we may have some small amount of inventory, but the main product that we're selling there is the service. So the inventory is not going to be the main category of the assets that we're going to have. On the merchandising business, however, we're going to have a lot of inventory. What will be the inventory? That will be merchandising inventory, which are already finished goods. So what we're going to do, we're going to buy finished goods and we're going to sell finished goods. Or we're going to buy merchandising inventory and we're going to sell merchandising inventory. So if I buy laptops, I can sell laptops. If I buy cell phones, I can sell cell phones. If I buy laptops, I cannot sell the cell phones because I don't have it. Now, if I want to sell the cell phones, I have to buy the cell. On the manufacturer, that's a different story. Now, the manufacturer is going to buy the simple material, which is the raw material. Then he's going to get the labor. Then he's going to add the manufacturing overhead cost. Then he's going to produce the finished goods. And after he producing the finished goods, he's going to sell the finished goods. So you can see if you follow the cash here in the merchandising, here we have cash. You're buying goods, you're selling goods, you're collecting accounts receivables, and you have the cash back. Where in the manufacturing company, you're going to buy the raw material, you're going to hire labor, you're going to spend for the manufacturing overhead, you're going to produce the product, you're going to sell the product, you're going to collect the accounts receivables, and then you're going to have the cash back. So you can see the part that the cash has to travel in manufacturing company compared to the merchandising company. In the service company, that's even easy. You sell the service, you get the cash. So again, let's go with the merchandising. Let's more focus on merchandising company and the manufacturing company. On the merchandising company, we're going to have assets, merchandising inventory. Now in manufacturing company, we're going to have assets, and then we're going to have under inventory, we're going to have first raw material. Then we're going to have working process because we're going to have some material which is start somebody working on it. End of the month coming, and we're going to leave it there. and we're going to count it as a work in process. And then we're going to have finished goods. Now, can we eliminate work in process? Technically speaking, yes, we can eliminate it. But in order to do that, means because all those reports here, the balance sheet, we're going to prepare it for the period of time. And the shortest period of time that we have for balance sheet is a month. Right? So in that time, in order we not to have a working process, you as a manager, what you have to do? You have to go to everywhere around the company and tell every person in the company or send them email or send them text message. You know, guys, after 20th or 22nd of the month, don't touch raw material anymore. Whatever you have in process, finish it. And I want work in process to have all the goods, all the products that you started to be completed. Because end of the month comes, I have to close the working process and that account has to be with zero balance. Is that realistic? Pretty much no. So for that reason, we're always going to have, if you're on the line to produce a laptop, so you're always going to have a few laptops which somebody start working on it, put the keyboard, but the screen is not there. So it's not going to be finished goods. It's going to belong to the working process. Again, the working process will be the partially complete product to some extent on the material, to some extent on the labor, or waiting for the overhead to be added. So now for that reason comes with some calculation. What we have to do? We have to calculate how much is the cost of goods sold. Before we go to the cost of goods sold, let's do some exercise. Very simple exercise. I'm going to open one Excel spreadsheet and let's work in this Excel spreadsheet. Do you remember T accounts? How many of you still remember T accounts? Okay, some of you do. All right. Great to see you, thumbs up. So, okay. Some of you do remember it, that's good. Now, let's go back to the T accounts. I'll make this one bigger. Try to extend it. And I'm going to start doing T accounts. I think that's more than enough. So what's happened in the T account? It's look like this. Now, which T account I'm preparing? I'm preparing first. Let's go with the merchandising company. And I'm preparing only I will prepare only the T account for only inventory, since we already know for that merchandising company as only inventory. I'm not missing one hole. Let's put that hole here. Here we go. That's our inventory account. What's the interesting with the inventory account? Inventory account, as we said, it's a balance sheet account, correct? Since it's a balance sheet account, what we know about the balance sheet account? Balance sheet accounts has a beginning balance and has a ending balance. Also, its insights is going to be included all the merchandising inventory that we purchase. On the left side is going to be debit. On the right side is going to be credit. Let's make it all right. Left side, right side correctly. Again, beginning balance, and then it's going to have ending balance. Now, what else we know about the merchandising company? In order to have the inventory, in the beginning, I don't have inventory. Let's say my balance is 0. Let's do some formatting here. So it can be easy to navigate here. I don't need the zeros. So let's say in the very beginning, my balance is 0. Then I need the inventory. What should I do? How can I get the inventory? What's the activity that I have to put in place in order to get inventory? Besides finding the cash and besides paying the vendors. How is the activity called when we're getting the inventory? Buy some or purchase. Once we start purchasing, we're going to have inventory. Let's say we purchase 50. Let's pretend this is, do you still remember this periodic system? Periodic inventory system. What's interesting in the periodic system? Every period, at the end of the period, we're counting the inventory. So we count the inventory. We already know we just started the business, beginning balance was 0. Then we purchase 50. At the end of the period, what we're going to do? We're going to count the ending balance, and we found we have 10. What that means? Did we sold something? And if we sold something, how much we sold? We sold 40, right? So, and what we sold is going to become part of the cost of goods sold. Where that cost of goods sold is going to go? That's going to go directly to the cost of, that we should see here, cost of goods sold. And that cost of goods going to go to the income statement. And in the income statement, we're going to have sales or revenue. Then we're going to have cost of goods sold. Then we're going to have a gross margin. Then we're going to have operating expenses. And after that, we're going to have operating income. That's the general presentation or general format of income statement. First comes cost of goods sold. Then we have gross margin first calculation, operating expenses, another calculation here. Actually, I don't need this one here. Operating expenses come another calculation, and then we have operating income. So the main objective here is we to get the cost of goods sold.
Ivan, can you share your screen?
Absolutely. Did I forget to share my screen? Let me see if I'm sharing something. I think I'm sharing my screen. Can you guys see it?
I can see it.
Everybody see the screen?
Yeah, I can see it pretty clear.
Okay, let's make it a little bit bigger if you want, like this. Is this better?
Yes, that's good.
Okay, so sales and sales, right? Cost of goods sold, that's our objective, to find the cost of goods sold. From where are we going to get the cost of goods sold? Obviously, for the inventory account. How are we going to get it from the inventory account? Well, we're going to follow simple calculation. What's the simple calculation? Calculation is beginning balance plus debit, always going to be equal to credit plus ending balance. And now depends what we're looking for. We're going to start flipping debit and credit or ending balance or beginning balance from left to right, left to right. Now, to make it, to adjust this formula, beginning plus debit equal to credit plus ending balance, to adjust it to our reality here, what we have to do, we have to replace debit with purchases, credit with cost of goods sold, beginning balance, ending balance is ending balance. So if you want to make it adjusted to this reality, what we have to do, we have to beginning balance plus purchases should be equal to cost of goods sold plus the ending balance. Now, if I want to find the cost of goods sold, what I have to do? Cost of goods sold, I have to simply get the beginning balance plus the purchases and then deduct ending balance. And I get cost of goods sold. That's if I do it as a formal way. Now, is there another way to do this calculation? Yes, there's another way to do this calculation. What we're going to do? We're going to start here vertical way now. beginning balance of inventory account. Then we're gonna add purchases. Once we add the purchases, we're gonna say, okay, now I have inventory available for sale. After deduct ending balance of inventory, what we're gonna get now? We're gonna get cost of goods sold. How this format is different than this? It's not different. We're just adding one extra line here, extra calculation to show beginning balance plus the purchases, what we have available for sale. That's the only difference. Everything else is the same. Make sense? So now, how can we interpret this? Well, very simple. Imagine this. Let's see this one formula. Let's put some formula here. That will be equal to beginning balance plus purchases minus the ending balance. So imagine this. You have in your pocket $50. You went to the IT machine and you withdraw 100. You went to Metro Town and you spent $80. How many dollars you have in your pocket? 70. How did you get it? Beginning balance plus what you withdraw minus what you spent give you the result, correct? Now let's do another thing. You don't know how much money you had in your pocket, but you know that you withdraw $120. You know that you spent $50. No, let's spend more. You know that you spent $150, and you know you check in your pocket and you found $30. How many dollars you had in the beginning before you get out of the house? Come on, what took you so long? You just have to express the beginning. Exactly. So what you're gonna do? You just flip the purchase on the other, debit, flip it on the other side, get the credit plus the ending balance, that's 180, minus the purchase at 120, is gonna give you 60. Correct? So what we're chasing here, beginning balance, and express it. Then you're gonna have credit plus ending balance minus debit in this case. Make sense? I need you fast on this. So let's practice more. You had $50 again. You withdraw 200. You went home, you found in your pocket 80. How many dollars you spent? Okay, 170. So now this is accounting, people. That's what we're doing in accounting. We have beginning, we have the debit, we have a credit, and we have ending balance. One of those will disappear. The question is, can you get it? Obviously, you can. How? Beginning plus the debit is always equal to credit minus the ending balance. So which one you're missing. If you're missing beginning, that means credit plus the ending balance minus the debit is going to give you the result. If you're missing the credit, the one what you're going to do, beginning plus the debit minus the ending balance is going to give you what you spent, credit. If you're missing the ending balance, then you get beginning plus the purchases, in this case, or debit minus the credit, going to give you the ending balance. And we can go back and forth, back and forth. The way I see it, you have here four options for questions. Either I'm going to ask you what's the beginning balance, either I'm going to ask you what's the purchases, either I'm going to ask you cost of goods sold. How much is it? Either the ending balance. There's no much game here. Only three options. Sorry, four. 1, 2, 3, 4 options. Why? Because I have 4 variables. Make sense? Now let's make it a little more practical now. Imagine this. You open your fridge. You're opening your fridge. And you're seeing that you have 2 liters milk in a jar. You know from experience that your kid's drinking 4 liters per week. And you know that at the end of the week, you have to make a cake for your daughter because she has a birthday. And you need at least 3 liters milk to make the cream. How many liters milk you have to purchase?
1.
Make sense?
No.
Isn't that what you're doing every day at home? Every day when you're going somewhere and before you go to the grocery, what you're doing? You're checking your fridge, see what you have, think about what you're gonna cook, see if you need something extra of that, and then you go into the grocery. You know that's why when you go to the grocery, but buy 3 bananas. Why? Because I know I have 3. If I buy another 3, I'm gonna have 6. I have 7 days, and every day when I get in the morning 1 banana, I'm gonna have 5 days per week. Saturday, Sunday, I can eat something else. And you're doing this every single day. So this calculation should come totally naturally for you. You can flip it on every way in the world. If you cannot calculate this, that means you don't care about your money. Because all the time when you go to a grocery store which says, we accept only cash, no credit, then what you're gonna do? You're gonna give them 20 bucks. And they're gonna say, well, how much? So once you give them 20 bucks, let's say they say 16, and you give them 20, and you say, okay, bye, I pay you. Is that gonna work? Or you're gonna sit and waiting for $4? That's your accounting, people. That's how easy the accounting is. I know we're gonna start to make it more complicated and putting in the position of merchandising company and manufacturing company and this, but at the end of the day, it doesn't change the fact that is what you have plus what you get is what you have available minus what's left, and that's how much you use. Or a beginning balance plus the debit minus the ending balance is gonna give you credit. That will be merchandising company. Let's see what's happening in the manufacturing company. Now, in the manufacturing company, to make it more difficult, because we have to make it difficult, otherwise it's not going to be a manufacturing company, we're going to have, instead of this one account inventory, we're going to have more than one account inventory. So what we're going to have in manufacturing company, this income statement now is going to disappear from here. No, actually, I'm going to leave it here. I'm actually going to leave it here, but I'm going to make this smaller because I need this, and I'm going to push everything on the right side in terms of Now in the manufacturing company, I'm gonna get cost of goods sold from the account called finished goods. And I'm gonna start going backwards. What that means. Now, in order to have the finished goods, I have to produce them. How can I produce the finished goods? Now I'm gonna start inserting columns because I need columns here. In order to get the finished goods, I have to have work in process. And the finished goods gonna come from work in process. When they gonna become when they gonna become a product? When I get direct material, direct labor, and manufacturing overhead. Once I have those three, now I can say, okay, I have finished goods. Now, since I produce those products, now I'm going to get cost of goods manufactured. Cost of goods manufactured then will be direct material, direct labor, manufacturing overhead, plus the beginning balance of the work in process, minus the ending balance of the work in process. Now, from where I'm going to get those? In order to get this cost of goods manufactured, which is going to move from working process into the finished goods. Let's make this for working process like this. Now look like a resting piece, isn't it? And what we're gonna do, note this thing. I want to insert a single line, which is gonna look like this. And that's how we're gonna move this cost of goods. Cost of goods manufacture into the finished goods. Now, don't forget, our objective is not to have those. We don't want to, why we want to manufacture finished goods? Because we want to sell them, right? That's the only reason. That's the only reason we get a business, to produce something so we can sell it to the client, so client can pay us cash. So let's go a little bit further and see from where we're going to get this direct material. Direct material, we're going to get it from account, which is called raw material. And from the raw material, now what we have to do now, we have to actually purchase this raw material. So you see how much time we have to spend in order to start with the raw material, work in process, finished goods. So the raw material, we purchase the raw material because if I don't purchase the raw material, I don't have anything. That purchase is gonna come here. Then when I use the direct material, that's gonna move one step further. That direct material is gonna come from the raw material account, my direct material that I'm using. Direct material used. And in all those accounts, I'm going to have beginning balance and ending balance. So now my objective is still the same. I still want to find how much is the cost of goods sold. Now I know that from the finished goods, I can get the cost of goods sold. Excellent. But that doesn't solve my problem. So from where should I start first? I'm going to start all the way from the raw material. So in order to get the cost of goods sold, first what I have to find out, I have to find out how much direct material I have used. Okay, so let's go. Direct material. First, we have to find direct material use. What we need to do? We're going to get beginning balance of raw material. Actually, before we do that, one thing that I want you to remember is on all those accounts, since the inventory account, the same formula applies. In all those accounts, we're going to have the same formula. Beginning balance plus the debit It's equal to credit plus the ending balance. Again, beginning balance plus the debit equal to the credit plus the ending balance. And again, beginning balance plus the debit equal to the credit plus the ending balance. Now I'm going to start repetition because I'm going to go stupid. So let's go with the practice now. Let's get direct material used. That's first objective from this account. From this account, our objective is, let's highlight it in green. Our objective is to get the direct material. What we're going to do? We're going to start presenting everything in the vertical order, not horizontal. We're going to get beginning balance of the raw material. Then we're going to add purchases. And those two together is going to give me direct material, raw material available. For what? For use. Once I deduct less ending balance of the raw material, then I'm going to get direct material used. Okay, my first objective is met. I get the direct material that I use in my production. What else I have to get now? I have to come here and start finding what else I need to get this cost of good manufacture. Well, obviously, we need the beginning balance of the working process. Then I have to add what I'm going to add. First, I'm going to get direct material used. Then I'm going to get direct labor. Then I'm going to get manufacturing overhead. Like this. So once I get all those, that will be all those three is going to give me my product cost. Only those three. It will be my product cost for the period. So let's get those together. Those three will be my product cost. Once I add the beginning balance into the picture, then I'm going to have the total cost or total manufacturing cost available to transfer. Okay, so far so good. The last thing that I have to do is less ending balance of this working process account. And once I get the ending balance of working process account, it's going to give me cost of goods manufactured. Cost of goods manufactured. And that's how we get the cost of goods manufactured. Now, once I get cost of goods manufactured, I'm going to go here and going to get the calculation for the finished goods. Now, for the finished goods, I'm going to delete this. And for the finished goods, what do I need? I'm going to get this beginning balance of the finished goods. Then I'm going to add cost of goods manufactured. And that's going to give me finished goods available for sale. Once I deduct ending balance of these finished goods, I'm going to get cost of goods sold, which I wanted to find in the very first place. But unfortunately, I have to go to all these calculations, one after another, one after another, one after another, in order to get those cost of goods sold. So first, again, we're getting cost, direct material used. Then we're gonna move to the work in process, and we're gonna get direct material, direct labor manufacturing overhead, which is our product cost. Then we're gonna add this beginning balance to get the total manufacturing cost, less the ending work in process accounts, gonna give work in process accounts, gonna give a cost of goods manufactured. Once we get cost of goods manufactured, I'm gonna start preparing the finished good calculation. This one, it doesn't need to be highlighted here. So let's get rid of this. It's gonna be beginning balance finished goods. We're gonna add cost of goods manufactured. And this is the one that's ready to be sold. Let's mark it in this case. And that's our cost of goods manufactured. Coming here. Available for sale, and then we're gonna get cost of goods sold. Make sense? So you can see now in the merchandising company, how easy to get it. We're working only with one account. Inventory, beginning balance plus the purchases, inventory available for sale, minus ending balance, cost of goods sold. Manufacturing company, that's not gonna work. So what we have to do? Start with the raw materials, find how much raw material we used. Then find out how much is the cost of goods manufactured. Once we find the cost of goods manufactured, then we can have to go to the finished goods account and find out how much is the cost of goods sold. Now, for your assignment and for your midterm, you have to prepare one of those schedules. I mean, the first schedule up to this point is called, all those two together is schedule for the cost of goods manufactured. Once we add the last one, finished goods, is called cost schedule for cost of goods sold. Now let's go now to the slides and see what's waiting for us in the slides. And I can flip back and forth with the Excel spreadsheet so we can do the calculations, the Excel spreadsheet so you can see the calculations. So again, we have this merchandising company and the objective here is very simple. We want to find out how much is our cost of goods sold. Now in the merchandising company, easy. We're gonna find it since we have one inventory account, only merchandising inventory. We're gonna check how much is the beginning merchandising inventory. We're gonna add the purchases. It's gonna give us available for sale. Once we deduct the ending balance, we're gonna get the cost of goods sold. In the manufacturing company, now we're not gonna chase inventory. We're gonna chase the last account, which is finished goods. In the finished goods account, we're going to see how much is the beginning balance. We're going to add the cost of goods which we manufactured. We're going to deduct, that's going to give us cost of finished goods or finished goods available for sale. We're going to deduct the ending balance of the finished goods, and we're going to see how much is the cost of goods sold. For the accounts, what we need to know? We need to know first, inventory is the balance sheet account. Also is an asset account. What that means, always have a debit balance. What also means, that means anything on the debit side is going to increase that balance. Anything on the credit side is going to decrease that balance. So the formula is beginning balance plus debit is going to be equal to the ending balance plus the credit. Debit, we're going to call it purchases. Credit, we're going to call it cost of goods sold. And now we are ready to do the calculation. So let's see this company that's merchandising. Obviously, if they have inventory, no questions about it there, dealing with the inventory. So here, if the inventory balance, beginning balance, was 1,000. They purchased 100. They sold 300. How much left at the end of the month? Everybody agree with the 800? Is there anyone who cannot see 800 here? That's what we're chasing here. Is there anyone who doesn't see 800? Does that mean everybody see 800? It's important for me to tell me, is there anyone who does see 800? So we can build on this because this one is crucial for the next slides. Okay, let's move on. Yes, it is 800. Why? Because we have 1,000 at the beginning. We add 100. That's 110. We deduct 300. 800 left. So now let's go with the manufacturing company. In the manufacturing company, to calculate the cost, first we have to calculate cost of the raw materials, direct labor, manufacturing overhead, which are used in the production. Then we have to calculate manufacturing costs associated with the goods that were finished during the period. And that's how we're going to get cost of goods manufactured. So we're starting with the raw material first, inventory account in the manufacturing company. Raw material, what we're going to get? We're going to see the beginning balance. We're going to add the purchases. It's going to give us raw material available for use. We're going to deduct the ending balance once we count the inventory. And we're going to see how much raw material we actually use. And that will be our direct material. In direct material, we're going to add to direct material, we're going to add direct labor, manufacturing overhead. Those will be given. You don't have to calculate it. We don't have to calculate it. And that's going to give us manufacturing cost for which we have for the period. Now, we still have to add beginning balance of the working process plus this manufacturing cost going to give us the total work in process for the entire period. Once we get that amount, we're going to deduct the ending balance in the working process, and we're going to get cost of goods manufactured. Now, once we get the cost of goods manufactured, then we're going to move to the finished goods account. We're going to start with the beginning balance of the finished goods. We're going to add the cost of goods manufactured, and now we have finished goods available for sale. Once we deduct the ending balance of the finished goods, we're going to see how much the cost of goods sold was for the period. Another way to do it for the cost purposes. Again, we have product cost, which is direct material, direct labor, manufacturing overhead. And we have the period cost, selling administrative expenses. First, we're going to start with the raw material. Raw material is going to go with the work in process account. The raw material, when we purchase it, that's going to be on the balance sheet. From the raw material, when we use it, we're going to go to work in process, which is also on the balance sheet. In the work in process, direct material has to meet direct labor and manufacturing overhead. Once that happens, we're going to have cost of goods manufacturing. Cost of goods manufacturing is going to move to the finished goods inventory, which is also on the balance sheet. And once finally we sell that product to the client, we're going to move to the income statement, which is cost of goods sold, where the period cost, which is sales administrative expenses, they directly go to the income statement account. We're not going to put them on the balance sheet anyway. We just directly expenses. That's why they're called period cost. another flow of the manufacturing cost. Now with a little bit numbers. Again, we get the direct material, we get the direct labor, we get the overhead. Those three together, when they meet each other, they have to meet each other in the working process. From the working process, they're gonna have to move to the finished goods as a cost of goods manufactured. Once we sell those finished goods, now they're available for sale. Once we sell them, they become cost of goods sold. Selling administrative expenses, on the other hand, they're directly expense on the income statement. Now let's do some calculation. First one. Let's beginning of the raw material inventory. Let's go with this. Let's copy this and let's move to the Excel spreadsheet. And I'm gonna flip this one here and let's start together with the first question. Paste it here as an example. Beginning of the raw material, which is our raw material account, is 32,000. During the period we purchase 276. Well, that's too many. Like this. At the end of the period, we count and we found 28,000 worth of raw material. Now the question is, how much direct material we have used? Now the other way we can do it is this way.
Sorry, I
What?
think your screen is
Yes,
off.
it's not. Now it's off, yes. So let's go back. It's good that it's off, so I can adjust it. Okay, here we go. How about now?
Yeah, we can see it now.
Excellent. Thank you for the fast reaction. Raw material, 32,000. We purchased 276. We count at the end 28,000. So let's use it here on this calculation. In the beginning, we have 32. Then we purchase 276. How much available we have? Well, once we get those two together, I can see how much available we have. 308. At the end, I count, I found 28. How many I used? It will be this one minus that one. Correct? Do we have it as answer? Okay, excellent. So now, before I continue, let's do something. I'm going to save this document. Just give me a second. Let me save it somewhere. Here on this device that I'm in. Okay, next thing that I'm gonna do is I'm gonna go to your course shell and under course material of chapter 2, I'm gonna post you this Excel spreadsheet. The reason for that is I want you to start using it. But before I do that, let me do something else for you. Let me multiply those screens. And let me change the questions here so you can participate in the questions. I'm not sharing my screen at the moment. Just give me a second. I want to adjust it a little bit. So once you have it, we can just start working. And you can actually use it for your calculation purposes. And we're going to work with exactly the same thing that we have available, you and me. I think that's fair. What do you think? And in that case, you'll be actually participants in the situation rather than just sitting and watching. All right. Let me share my screen. So where I'm going to post it, I'm going to post it under additional materials. No, I'm going to post it right here. So document, which will be cost of goods manufactured, save. Let's unhide it from you. And let's save it. And that will be calculation of cost of goods sold. And once I close it, you're going to have calculation cost of goods sold. That's for the today's section. Let's move it now to tomorrow group. And let's do the same thing there. Again, it's going to be under the course material, chapter 2, and right here in the middle, before the resources. Well, and that will save here and make it visible for you. And I'm going to change the name, save, and you have it available. So all the participants now, you guys have this Excel spreadsheet. Now what I want you to do is grab it. Let me know if you have it, and let's continue with the slides. Can you guys find it? Awesome. Now, I'm going to share my screen with the slides. So what's happened now? The first question was with 32 to 76.28. So the answer here is the beginning balance plus purchases give you available minus the ending balance give you how much you use in production. Let's move to the next one. Now we have direct material, which meeting direct labor and manufacturing overhead. The question is, what's the total manufacturing cost? So what we have to do, we have to open the Excel spreadsheet, which will be on the section number 3, manufacturing number 3, worksheet. And then we're going to have this question here. So what we're going to do is, I'm going to flip it a little bit here. And what I'm going to do, I'm going to make this wider. I'm going to start. I have direct material 280. I have direct labor 375. And I have manufacturing overhead 180. And that should be give me the total of the total manufacturing cost for the period. Is that how we're getting it? I'm not sharing my screen, but now I can share it with you since you have the same format. Again, go to the worksheet manufacturing 3. You have the question here. Fill the gaps. Put the formula and you'll be there. Is that what you guys getting? Awesome. So from the slides, go back to slides. From the slides, if we have to scroll down, the calculation simply will be all those three costs together, 835. Now let's see next question. Next question is working process. Let's add now the working process. In the working process, we have beginning balance of 125. Manufacturing costs, we already have it. And the finished goods remaining working process inventory at the end is 200. The question is, how much is the cost of goods manufactured during the month? Stop sharing this, move to the Excel spreadsheet, and see what we're going to find there. So what I have here, that now I have to move to manufacturing 4. Once I move to manufacturing 4, I have to add this one here. Now I have two options. I can copy it from this question and move it to manufacturing 4. And once I paste it, I'm going to have this cost. What I have to add? I have to add the beginning balance, which beginning balance for me is 125. And let's format this one to be the same. Now that 835, I can easily move it right here. And I can get total manufacturing cost will be that much. Ending balance on the question is 200,000. And now I can get the final results. Is that how you guys doing it? So how much you get? Let me share my screen and see what you're saying on the chat room. How much you guys get for the cost of good manufactured? Excellent. Are you using the Excel? Excellent. And the last question, obviously, so this question, the answer will be beginning inventory working process, adding the manufacturer work, the total work minus the ending inventory, gonna give you 760, which is the cost of good manufacture. And the last one is now let's get the finished goods. On the finished goods, what we're gonna get. So for the finished goods, to get the finished goods, what we have to do is we have to go to one worksheet on the right. On the right side, which will be the last one, manufacturing number 5. And once you get the manufacturing number 5, now what you have to do is you have to fill up the gaps from the previous one, if you want. Grab this thing here. Let me grab it somehow and move it around. So once I move it around, actually make it bigger. I didn't want to do that. I want to just grab it and move it like this to open the space. And now I have my beginning inventory, which in this case is 130,000. Then I have cost of good manufacturing 760,000. Available, I can easily calculate it. Then I'm going to deduct the ending balance, which is 150. And going to give me cost of goods sold, which is this one plus that one. No, not plus, minus, right? I have to deduct it. Getting too much. Make sense? Let's share now the screen with the slides, and let's continue with the slides now. So let's think about it. I want you analytical skills now. What's happened with the inventory in this company? Finished goods. First thing first, we can see the cost of goods sold as 740. What that means to us? Are we selling whatever we produce? Are you guys there? Can you guys hear me? We produce finished goods for $760. Our cost of goods sold are 740,000. Are we selling what we produce? So yes, we still have 20,000 left. Is that good for the company? So what that means? So someone says yes, somebody says no. If you say no, what's your logic? If you say yes, tell me what's your logic. Why is yes and why is no? So most of it, I mean, like this is the same thing. Like listen, it's like you almost get A plus, but you just didn't get it. Is it A plus? Not really, right? So either you're selling what, because listen, the other thing is if you're producing more than what you're selling, and if that continue period after period, you eventually going to end up with inventory. If the inventory is not perishable, that's okay. But imagine this one: you're producing and selling. You're in the bakery business, and what you're having right now, you're not selling bread for $200,000 to $20,000. Is that good for you or not? Make sense? So that's what I want you to start seeing as a managers, not just calculation. Calculation, we can get one kid from grade 3 to do the calculation. Beginning plus cost of goods manufactured minus ending balance. He's going to get it. He's going to be excited because once oh, you're doing great job. Oh, excellent. Now the calculation is calculation. That's fine. I want you to start seeing things. Is it good for us to purchase more than what we're using? It is because, as you can see, our beginning balance, we had 130,000. Now we have $150,000 ending balance. Now, if you're in the bakery business, that's not good for us. Now, imagine we are in the fresh flour business. We are selling fresh flours, people. Right? Or imagine we are on the selling of chicken eggs. Okay, we're gonna put them. Okay, you're gonna say, okay, let's put it on the freezers. We have all those ginormous freezers. That's excellent. We can keep it on the freezers. But for how long we can keep it in that freezer, right? That's one thing that you have to start seeing. Balances. You have to see the balances and you have to think, okay, what's happening here? Is it going up or is it going down? What we're producing, is it what we sell? Or what we sell is not what we produce. Do we need inventory? Oh, we don't need the inventory. The inventory to have it is good, but that means you don't have the cash. Make sense? And at the end of the day, you didn't open your company to have more inventory. You opened the company to have more cash. More inventory doesn't mean more cash in your pocket. Maybe if you're doing on the household, having more grocery in give you more opportunity you to cook more variety of food. But in the business, having more inventory, that means you missing the opportunity to sell this inventory and to increase the inventory turnover, which the inventory turnover is going to give you more cash. That's how I want you to start seeing those events that's happening in the company. Now let's see the classification of the cost. And the classification, again, for different purposes, we're going to have different classification. Now, for this chart, I want you to understand again this. I cannot change the cost. I'm getting the cost from my accounting software. Costs are the costs. The other thing is they already happened. They're in the past. I cannot change them. But what I can do is I can get a different classification for the same cost. I can start breaking the cost on different parts or can have a different classification of the same cost. So in other words, after every classification, the new classification that I do, I always going to have the same total, the total of my total cost from the accounting software. So one way to classify the cost will be the product cost on the period cost. But at the end of the day, the total cost will be exactly the same, which is on the accounting software. Why? Because that's the same cost. Now I can break the cost in the product cost and the period cost, but the total cost will be the same. Total product cost, I can call them inventoriable cost. I can break them into direct material, direct labor, manufacturing cost. But once I combine direct material plus direct labor manufacturing cost, it's going to give me the product cost. Plus when I combine with the period cost, it's going to give me the total cost, which is on the accounting from the accounting system. Period cost will be non-manufacturing cost, which is marketing, selling, administrative. So that's why we have, based on the financial statements and who's using it, we're going to have a product cost or inventoriable cost or period cost. Product cost is direct material, direct labor manufacturing overhead, where the period cost is everything that is expense during the period. Now, the other classification that we're going to have for based on the prediction of the cost. Now we're going to start predicting the cost. In few minutes after we finish with these slides, I'm going to start teaching you how to become artificial intelligence. Means how to predict the cost. Right? We see how the cost behave, and then we're going to start predicting it. Same thing artificial intelligence doing. The artificial intelligence collecting the information about how the human behave and try to predict the future based on the past experience. Same thing here, no difference. So after not after today, but after the next lecture, you'll have artificial intelligence. So you don't have to use that ChatGPT anymore. You see, that's the benefit of this course. So based on how the costs behave, we're going to have variable cost and we're going to have fixed cost. And we're going to see how one behaves, how the other behaves. Now, when we're assigning the cost directly to the object, we're going to have two types of costs. One will be direct cost, one will be the indirect cost. Now, the easiest way to find out which one is direct cost is look for the adjective direct. If the adjective direct appears in front of the cost, is direct cost. If the adjective direct, it doesn't appear in front of the cost, is indirect cost. For example, from the product cost, when you see direct material, obviously that's direct cost. Why? Because it has the adjective direct in front of materials. Direct labor, direct cost. Why? Because it has adjective direct in front of the labor. Indirect labor, it doesn't have adjective direct, so that means it's indirect cost. Indirect material, same thing, doesn't have adjective direct, that means indirect cost. Now we're going to utilities. Utilities doesn't even have any adjective, so that means directly indirect cost. Depreciation, does it have direct in front? No. Indirect. And that's how easily you can assign the cost to the object based on the direct and indirect. And the last one is for the making decisions. Eventually, we have to start to make decisions once we understand how the costs behave. And once we start predicting the future, we can start making decisions. For decisions, we're going to find that there is a differential cost, which is different between the alternatives. Sunk cost, we're going to see a little bit later what is it, and opportunity cost. And those are basically the main classification on the costs in this introduction to managerial accounting, which is mostly about the cost. So now let's go with the classification of how the costs behave. Now we're going to have a special chapter, which is chapter 3, which is I'm going to talk mostly about how the costs behave. I may even start that chapter today, see how the time goes. So since we want to predict the cost, we want to know how the costs behave. And the way the costs behave, they behave in two ways. They behave as a variable cost, and they behave as a fixed cost. Before we go there, I want you to understand one thing, just to make one thing clear. Cost itself. Let me see, where can I find some space here? I'll build myself space here, right here. Cost is always mathematical function between two variables. One of the variables is quantity. The other variable is a price. If you don't have a quantity, there's no cost. If you don't have a price, there's no cost. So those two have to meet together in order you to have cost. For example, you're going to buy coffee. You're looking the board. Every coffee shops have it. Some don't, and you start guessing what should I order here. Assuming that you already know, or assuming that they have a cell phone, which cell phone actually have an app for that store, and you just look at them. I don't. Sorry. I would prefer something printing so I can see it. I'm more visual person rather than technology person, but they don't understand that. Anyway, so once they see that the price of the coffee, let's say cappuccino cost $5, no, this is just a price. Is it cost for me? Not yet. When is going to become a cost? When I match price with the quantity. When I say to the person, I want one cappuccino, and he's going to tell me $5.75. And I say, why is this there $5? And he's going to say, well, that's because there's a GST or some other tax, but that's a different story. Let's see, avoid the taxes from this point. But again, the point is, cost for me is because price and the quantity meet together. If I have only price, I can watch all day the menu, right? The cost for me is going to be zero. That's why I like what my daughter says. Let's go and do some window shopping, right? You're going and watching in the stores in Metro Town, and we're doing window shopping, right? Because we look in the prices. What's the cost for us? Zero. Why? Because the price doesn't meet the quantity. Now, when she say, oh, that I want this, now the quantity start meeting the price. And when we go to the cashier, then become a cost. Make sense? So now, once we know what the cost is, now we're going to have two types of costs. One is variable cost, which always going to change based on the activity. And then we're going to have a fixed cost, which is going to unchange based on the activity. So let's see how this is going to work. Variable cost. Texting, let's forget about texting. Let's go to potato. Let's buy some potatoes. If I go to the store, let's say superstore, and if I want to buy potato on not by piece or by pounds, what I'm gonna see that the potato costs $1 per pound. What that means to me, if I buy 1 pound potato, I have to pay $1. If I buy 2 pounds potato, I have to pay $2. If I buy 3 pounds potato, I have to pay $3. So more I buy, more I have to pay. But I might decide I don't want potatoes. Then my cost will be 0. Why? Because I'm not buying anything. But regardless how much I'm gonna buy, how many pound potato I'm gonna buy, my cost per pound is always gonna stay the same. If I buy 10 pounds potato, I'm gonna pay $10 because cost per pound for every pound that I'm adding is exactly the same, $1, $1, $1, $1. So cost per pound doesn't change. So that's how variable costs behave. Variable cost per unit always stays the same. Variable cost in total always goes up based on the level of activity. Activity in this case will be how many pounds potato I'm buying. If I don't buy, I don't have to pay. But that doesn't change the fact that the cost per pound or per kilogram potato is $1. Now let's see the total, the fixed cost. Before we see the fixed cost, let's see what actually drives the variable cost. Variable cost can be driven in the company on the different activity. One can be based on the units that we produce. I want to generate more profit. In order to generate more profit, I have to increase my sales. In order to increase my sales, I have to produce more units. But if I produce more units, my cost for the production is going to go up. So what drives the cost in this case? My production. More I'm producing, more cost. Less I'm producing, less cost. The other thing can be machine hours. If my machine working 1 hour, my cost will be less. But more my machine works, more the costs start going for me. If we're using the car, then it will be based on the mileage that the car drives. If you don't drive the car, there's no cost. More you're driving, more you have to pay. Less you're driving, less you have to pay. Labor hours is the another thing. I want to produce more products, but now I have to buy more material. Okay, cost for the material goes up. But now I have to hire more people. Well, that labor hours start going up. And when the labor hours start going up, my variable cost for the wages is going to start going up. That's with the variable cost. Again, I'm going to talk about variable costs more in chapter 3. Let's see about the fixed cost. Fixed cost compared to the variable cost always stays the same. Total, as a total. Fixed cost as a total always stays the same. Example for the fixed cost will be your cell phone. If you're on the plan, you're paying fixed fee for the plan. Let's pretend the fixed fee is $50. Doesn't matter how many text messages you're going to send, the cost always going to be $50. If you don't want to talk, talk. If you don't want to talk, don't talk. But the cost is $50. Same thing will be with the annual insurance of your car. It's a fixed cost. Now, are you going to drive? It's up to you. If you don't want to drive, don't drive. But how this going to reduce your fixed cost? It's not going to reduce. How this going to change the insurance? It's not going to change it. The cost always going to be stay the same. Now I know the monthly pass for the SkyTrain, that's not sensitive to you because you already get it from Douglas College. So I'm not going to use that as an example. Now that's in total. So the fixed cost in total stays the same. Now let's see how the fixed cost per unit behave. Let's go back to the cell phone. If you're paying $50 for unlimited texts, if you send only one text message, how much is the cost for that text message? $50. How about if you send two text messages? It's going to be $25, correct? How about if you send 10 text messages? So what's your incentive? How can I reduce that cost per text message? By using it unlimited. Now, if we are in class, at this point, I'm going to tell you. Now, I understand that the text message is something incentive for you. And the only way you to reduce the cost for the text message is to text. And then I'm going to encourage you to please, when you're in the classroom with me, text. Why? Because I understand that it's a fixed cost, and the only way you to reduce the fixed cost per unit is to use it unlimited. So go for it in my class, text. But then we're going to come to another question. If the cell phone plan is your fixed cost, total fixed cost, and then the usage determine how much will be the cost per text message, how about the cost for the course? What kind of cost is it? The cost that you pay for this course, what kind of cost is? Fixed cost or variable cost? It's a fixed cost. Correct? So now, if you pay attention during the semester, 1 minute, how much is the cost of that minute for you? $100% of the course cost. So how can you reduce the cost per minute for the course? Maximize participation, pay more attention. Make sense? But now we have a conflict, and I know now you have a conflict. So what should I do? Pay attention or text? Because if I'm texting, I'm reducing my text messages. But if I pay attention, I reducing the cost for the course. So which one should I do? Now, as a manager, you have to make a decision now. So if you magically calculate that the text message cost you more than paying attention, then text, you're doing the right decision. But if you come up with the idea that the cost to pay attention in the class is more than text message, then I'm going to ask you what kind of manager you are. Because at the end of the day, those are your money. So do you understand now how tricky is the whole thing? I want, you want to something, but at the same time, you have to think about it, where the consequences. So for that reason, I strongly encourage you, get the maximum benefits from the courses that you're taking. How? By paying attention. More minutes that you're paying attention in the class, that's going to reduce the cost per minute. But at the same time, if you pay more attention in the class, most likely you're going to get more knowledge. So now the benefits that you're going to have from every course will be way more than the cost per minute. Do you understand this logic? And that's how you're not wasting your money. Now, if you apply this logic on everything that you're doing in your life, you're going to see a lot of opportunity here, because most of our costs today tend to behave as a fixed cost. We just pay it, but most of them we just don't using for one reason or another reason. We always find a good reasons if you don't want to do something. That's why I generally split the general population are two types of individuals. One is the one who wants to do something, the other one who doesn't want to do it. The one who wants to do something, he's going to find a way to do it. The one who doesn't want to do something, he's going to find reasons not to do it. Same thing like fixed cost. You know that it's fixed cost. You know that you're paying it, and you know that you don't using it, but you're not doing anything about it. And you're just always excusing with something else, instead of taking the maximum benefits of something that you already paid. So for that reason, yeah, somebody, if you're talking about the courses, some of you can say, yeah, but the course is boring. And the teacher is boring, and there's nothing I can learn from this course, and it's so hard, and this and this and this. Again, I'm listening excuses. Yes, in the most boring course, you can still find something valuable for yourself, you as a manager now, because I told you, in order to understand this course, I want you to become a manager and to start seeing the values and the benefits that you can take from everything that you're doing. And that's the way that you're going to increase your value, and that's the way that you're going to increase your cost. And that's how you're going to get the maximum benefits for everything that you're spending, which for you is the fixed cost. And that's how you're going to reduce the unit cost for the fixed cost, which is your only opportunity to profit. Because as you can, the way I see it, watch this. The variable cost per unit is stable. It's stable. Fixed cost per unit is stable. Variable cost in total climbing up. The only one of those costs that actually going down is the fixed cost per unit. Another example will be, let's say, rent. What kind of cost is the rent? It's a fixed cost. So if you pay $2,000 for one bedroom apartment and one person living in that one bedroom apartment, how much is the cost per person? 1,000. How about if you put two people? Five people? So what's the point here? You to put in that one bedroom apartment, 100 people to live. And that's how you're going to get the maximum benefits. Now, obviously, that's not going to happen. But as an example, at least you can kind of sense it. So please utilize your fixed cost and start using it in your benefits. Take the maximum. If you go, let's see this one, a relevant range. What's the relevant range? A relevant range is the range of activity which all assumptions about the fixed cost and the variable cost are valid. What that means that if variable cost per unit is the same, within that relevant range, variable cost per unit is the same. So the only thing that derives the variable cost will be usage. And fixed cost within that relevant range is the same. Simple example will be this. I'm going to go to these numbers in a second, and I'm going to explain those numbers. But before that, I want to give you the example. If you have to rent one-bedroom apartment, you pretty much know what's the highest and lowest point, correct? Now the question is, since you already know for one-bedroom apartment, you have that price range. That's the price range for that one bedroom. Now, if you want to move to the two-bedroom apartment, then you move into new range. If you want to move to three-bedroom apartment, then the price range is getting different. So the relevant range will be determined by the size of the apartment. Bigger apartment, bigger cost. Same thing is with the business. If your business operates within certain capacity, all the fixed costs is going to stay the same. If you move business to the new level, most likely the fixed cost is going to double. And then you have to make the decision, which decision sitting under these numbers. Imagine this. I'm not teaching this course through Douglas College, but I'm teaching this course on my own. I'm approaching Douglas College and ask them, can I rent a room from Douglas College? And they say, yes, you can. All right. How much for the room? And they say, the room will cost $2,000. That will be the cost for the room. However, in that room, you can put only 20 students because it has only 20 chairs. And by the contract, I cannot get anyone more. I'm charging students $200 for the course. And my revenue is $400. I'm paying the $2,000 rent. So my net profit is $2,000. At some point, I see my waiting list. My waiting list, you know, the waiting list. And I'm thinking, should I get more students? And I'm asking this Douglas College, can I rent bigger space? And they say, yes, you can. But the cost for the rent going up. Then the next available space is not 20 seats, 40 seats. But the cost will double. It's become $4,000. Now, the question is, if I have only 5 students on my waiting list, should I rent another room? Or should I go with the bigger space with only 5 students on my waiting list? So that's where the calculation comes. If I have 5 students on the waiting list and they pay me $200, that will be $1,000 additional to me. But my cost for the room, for the rental, already jumped with another 2,000. So the 1,000 additional that I'm going to get for the 5 students on the waiting list is not going to be enough to cover the additional fixed cost that I'm going to have by moving to the bigger room. In fact, I'm going to lose $1,000. So how many students I need to have in the waiting list in order to get the bigger room and to get exactly the same profit that I'm getting in the smaller room? If I get 20, that will gonna double. I'll get 30 students. So that means 10 additional students. If I have 10 additional students, then those 10 is going to give me the $200, which going to cover the extra cost or double the cost for the room renting. Make sense? How about if I get 31 students now? I'm going to start making more profit than before, correct? We're going to come to this idea when we start doing cost volume profit analysis. But now you can understand that once I move to one capacity of the room to another capacity of the room, my fixed cost dramatically change. So the small increase in sales might not be enough to cover my additional fixed cost that I'm having. Well, guess what? Most of the businesses and most of the business owners, they don't understand this. That's why you can easily see a profitable business which decides to go to the next level after 3 months disappear. That's a common example on the business entrepreneurs. They see the business going well, they getting greedy, they saying, okay, I want to move, I want to increase the business. And they end up only doubling the fixed cost. By the time they're realizing that, the business is already out. We're going to talk about this later, and we're going to talk about the capacity. What I want you to understand now is that we have costs behave in two ways, as a variable and as a fixed cost. And they behave in total and per unit. So variable cost per unit always stays the same. In total, always increase or changes based on the level of activity. Fixed cost in total always stays the same. Per unit always goes down. However, fixed cost never gonna reach per unit, never gonna reach zero. Why? Because you already pay for it. It doesn't matter how many text messages you're gonna send. You already pay $50 for the text messages. The price may go 0.0001, but it's never gonna go zero. So which of the following costs with respect of the number of cones sold at Baskin-Robbins shop? Again, which of the following costs would be variable with respect to the number of cones sold by the Baskin-Robbins shop? You know where the Baskin-Robbins shop is, or one of them, in Metrotown, on the second floor, I believe, close to the parking lot on the second floor. So let's think about it. First, again, the driver for the cost and how we try to get the variable versus fixed is based on the number of the cones. Cost of the lighting in the store. What kind of cost will be that? Variable or fixed? What will be fixed? For lights, yes. Again, we're looking from the perspective for the number of the cones that we're selling. So not number of the cones that we sold. That's it. So the question that you should ask is, if I'm not selling the cones, if happened that I'm not selling the cones, should I turn off the light in the store? I'm not selling. I mean, like between 12 and 1 o'clock, I don't. It just happened. I don't have clients. Should I turn off the light? You open the store no matter what, right? Exactly. So yes, the cost of the light is absolutely fixed cost in respect to the costs that we're selling. You're not going to turn off the lights every time when the client, and what you're going to say to the client, can you get out faster so I can turn off the lights and can save some of the cost? Because that's a variable cost for me. That's not going to work, right? How about the wage of the store manager? It's a totally fixed cost. It doesn't matter how many cones you're going to sell, you still have to pay the manager. How about the cost of the ice cream? In respect to the variable cost, right? More we're selling, more cones we're selling, more ice cream we have to buy. How about the napkins? Variable cost, right? Because we have to put napkins on every cone. More we're selling, more we. Now, in that case, question for you. What kind of cost, every coffee shop have this stationery, which give you a cream, milk, half and half. In JJ Beam, I saw the other day, they give you oat milk, almond milk. What kind of cost is that for them? It's a variable cost, right? So if you want to understand this course and if you want you to take the maximum benefits, since we are super early in the course, I would strongly suggest you this. Everywhere you go, I know you're going now. It's a long weekend coming, all right? And probably you're going to go one place, another place, and one store, another store, coffee shop, or wherever you go. When you go there, think about it. Which one is fixed cost? Which is the one is variable cost? And think about it. If I am a manager, what can I do about this? And which cost going to give me, from which cost I can make more money? Try this exercise and next time tell me how it works. Go somewhere and start thinking. What kind of cost is this? What kind of cost is this? This way you practice so many things. First, you practice obviously the understanding of the variable and fixed cost, but also observing, pay attention, getting ideas, your imagination, and see what's going to happen. What will be the benefit? So that's the correct answers. Let's go with the assigning cost to the object. Again, we have direct cost and we have the indirect cost. Direct cost is the one can be easily community traced. Again, the example will be all the costs that have adjective direct in front of the cost. Indirect cost will be the cost that cannot be easily community traced to the object, which will be manufacturing cost. The last cost that we have to cover today is the decision making. Let's have a short break and let's do the decision making. Decision making. Decision usually involve a choice between alternatives. usually you have to have at least two alternatives in order to make a decision. If there's only one alternative, there's no decision, you just take what's available and move on. Now, only the costs and the benefits, which are different between one alternative and the other, are relevant when you make a decision. All the other costs and benefits can and should be ignored. Again, only the cost and benefits which are different between the one alternative and the other alternative has to be taken in consideration and are relevant in order you to make a decision. Everything which stays the same as a cost and the benefits should be ignored. Differential cost analysis is very simple. Instead of preparing financial statements to see what's the effect on the income and what's the effect on that, what we're going to see, we're going to chase the benefit. We're going to see how much is the cost, what's the difference between those two, and we're going to make a decision. For example, let's pretend you have the job that paying $1,500 per month. Now we have a new job offer, but you have to travel to another city, which paid $2,000. The cost to commute between one city and another city is $300 per month. Would you take the job? So first we have to see what's the differential revenue. Differential revenue is currently I'm getting 1,500. If I do the new job, if I get the new job, I'm gonna make $2,000, which gives me $500 more. But additional cost for me will be $300. From the additional revenue, once I deduct the additional cost, is there anything left for me? So in that case, should I take the new job? Obviously, for $200, depends. Yes, true, depends. But let's base only on the cost and additional income. Yes, in this case, yes. So how about this? Opportunity cost. Opportunity cost is something that we don't have to pay, but we have to consider. Opportunity is the potential benefit that we're giving up if we choose to go with another option. For example, right now you're sitting here and listening to me. What's the opportunity for you? Opportunity is you to go and work and make $20 or $30 or $50 per hour. Now the question is, listening the lecture and getting this knowledge, is it give you more than $50? If that's the case, then you're in the right place. If that's not the case, then you should go and work. But again, opportunity cost, again, is not something that we have to pay, but we always have to consider. And it's what we're giving up as a potential benefit if we choose to go the other direction. So example will be, if you're not attending the college, you can earn $15,000 per year. The opportunity cost obviously will be attending the college for 1 year. It will be $15,000. So if you decide to attend the college, you're missing the opportunity to earn $15,000. Now, the interesting thing that happened to me is my son coming one day at home and he's telling me, Dad, do you know, in the science or whatever, or the what they call it now, the job fair or something, I don't know, something related to how they choosing the profession and that kind of discipline at school. The teacher told them that it's more profitable if they, after they finish their grade 12, become a garbage truck driver rather than going to the university and become a lawyer. And I say, why is that? Because for the garbage truck driver, you can easily get a license for $3,000 and right away you start making money. Where in the lawyer, you have to go to university, you have to study for 6 years, and you have to spend $100,000. So it's a way better you to spend like a $3,000, start making money as a garbage truck driver rather than going to the lawyer. And I'm looking at him say, oh, really? That's what they're telling you now in school? That doesn't make any sense. So I did some research for the sake of the exercise. I did some research. You know, the interesting part is the garbage truck driver, the highest possible salary for the garbage truck driver, he can reach it after 10 years experience. It's going to be, right now, it's around $95,000. On the lower side, the junior lawyer, after the graduation from the law school, the minimum starting salary is $130,000. Now, after 3 years, that's the range. When you start at 130, after 3 years, the lawyers get increased. They're going to the, I believe the amount is 170 is the minimum. They're going to the range 170 to 210. After 5 years experience, 5, 6, 7 years, the minimum available for the lawyer is $230,000. The maximum, it will be when you become a partner and you can make more than $1 million. Now, then I did another projection again for the exercise. If you stay as a junior lawyer for the entire life after your graduation, right? Considering graduation, you're losing 6 years of like a working income, plus you're paying $100,000. You're still going to make $4 million more than truck driver over the lifetime from the retirement, when you start working until the retirement. And I'm thinking how these people who teaching these kids actually come up with this idea about the opportunity cost, because like I see the point. Yes, you're not spending $100,000, which $200,000 in 6 years in the law school, right? And your opportunity, if you go that direction, and then for the 6 years, you're losing the opportunity to make $65,000 per year as a truck driver. But after that, those money, you just getting it back within a few years, you're where the truck driver is. And after that, there's no stopping for the lawyer. Interesting how the people seeing the opportunity cost and how they calculate it and interpret it in the different realities. Let's go to another cost, which is a sunk cost. Sunk cost is the cost that already happened. There's nothing we can do about it. We cannot change it because, again, it's already happened. So for the decision making, we're just ignoring it. Example will be, you bought a car 2 years ago for $10,000. Now, the $10,000, that's a sunk cost. Whether you decide to drive it, park it, trade it, you cannot change the fact that you spent $10,000 for the car. Let's see this question now. Suppose, now pretend that you're trying to decide whether to drive or to take a train to Portland. You want to see the concert in Portland, and your decision is, should I drive or should I take a train? Cash is not your problem. You have enough money, so the cash is not a driver for your decision. Now the question is the cost of the train ticket relevant for your decision? In other words, is the cost of the train affect your decision whether to drive or take the train? Absolutely, yes. It's a relevant cost. No questions about it. Same idea. You want to go to Portland to attend this concert. You're thinking, should I drive or should I take a train? Cash is not your problem. You have enough cash. The question now is the annual cost that you already pay for the licensing your car relevant for your decision? No, it's not. Now, if you want, we can think about this. How many of you have a car? How many of you paying this annual insurance for ICBC? Quite a few, right? Okay. How many of those of you who have a car and paying annual insurance for ICBC have traveled in the last year somewhere outside of Canada? Have you traveled outside of Canada? So for those of you who travel outside of Canada and paying the ICBC, when you go into the airport, have you ever seen a person coming to you and ask you, hey, where are you going? And you say, okay, I'm going for a 2 weeks trip. Oh, you're not going to be in Canada? No, I'm not. Have you paid your ICBC insurance? Yes, I did. You know what? Since you're going outside of Canada, you're not going to use your car, correct? Yes, I'm not going to use my car. Then, you know what? I'm going to give you a refund for the 2 weeks that you're outside of Canada, because obviously you're not going to drive your car. So ICBC decides to give you that refund because we care about our customers. Have you ever see anything like this? Yeah, but if you cancel it, that's a long story, and they're going to charge you a processing fee of something. So that's going to eat your savings and everything. So don't cancel it unless you're going for a trip at least 7-8 months. Right? If for trip for 14 days, don't even bother cancel it unless it happen that the insurance expires. But that's a different story. Then you're going to tell you that you still have to pay this parking insurance. So if something happened when you're parking your car, you're actually covered. Otherwise, you're not going to be covered. They have so many tricks there. So, but yes, the licensing cost in this case is irrelevant. Let's go with another one. Now, suppose that your car can be sold for $5,000. It's a tricky question. Now pretend that you can sell your car for $5,000. Is this a sunk cost? The first thing that we have to ask ourselves is this cost at all? I'm selling my car. Is this cost for me? It's not cost, right? So the rest is what kind of cost is it? It doesn't matter because it's not a cost. So since it's not cost, is it going to be sunk cost? Is it going to be opportunity cost? It doesn't matter because it's not cost. Make sense? So let's go to the summary for this chapter. As the summary is cost classification. For financial reporting, we have product cost and we have the period cost. For predicting cost, we have variable cost and we have a fixed cost. For the assigning cost to the object, we have direct cost and indirect cost. And for the decision making, we have relevant cost, differential cost, sunk cost, opportunity cost. We're going to see all those cost decision making in chapter 12 when it comes to chapter 12. Now, there's a question in the chat. Let me go back. Can I explain the difference between the variable and fixed cost once again? Yes, I can. So now let's go back to the idea with the variable and fixed cost. Now, again, the cost, before we go there, cost always going to be function of two variables. One variable always going to be price per unit. The other one will be quantity. Now, the way I see it, you have two options. Option one, decide not to buy. That's not going to change the price, correct? Whatever you have to buy, it comes with the price. Now, what's going to drive the cost then? Only the quantity. Now, we have items that we need, which is driven by our activity. And we have prices that we cost that we pay because we just have to live. Now, some of those activity we can eliminate. Some of those activity we cannot eliminate. For example, I cannot eliminate the fact that they have to go to a place which has a bed which I can sleep. So that means either I have to rent apartment, either I have to buy apartment. Let's pretend that I'm renting apartment. Then I have no choice, but I have to pay for the rent. Now, what kind of cost is this for me? Is it variable cost? Is it the fixed cost? Is it something that I can eliminate or I cannot eliminate? We're going to see next time, we're going to explain more about this. So that's a fixed cost. And that cost is not going to change for the period of time, for 1 month. After 1 month, I have to pay again, and I can have this apartment for 1 more month. Now, since the cost doesn't change within the period of time, that's a fixed cost. And since we're paying the total cost of the rent represents the total cost, that's total fixed cost. Now, what drives that cost is the people who are living in that apartment. So you cannot live in the apartment, you cannot live outside, so you have to rent the apartment. So now how many people is going to live there? If we have to calculate the fixed cost per person for the rent, if we're paying $2,000 for the rent and 2 people living there, the cost per person is $1,000. So if they want to share the rent, they can share $1,000. If we 4 people living there, then the cost is going to be $500. Now, the variable cost, on the other hand, is something that we can avoid, you can eliminate. Or we can pay as we need it. For example, I have a car for which car I have to pay insurance, which is annual insurance. I cannot drive my car if I don't pay the insurance. Make sense? So now I'm paying my insurance. My insurance is fixed cost. But then I want to drive my car. But if I drive my car, I have to pay for the gas. What kind of cost is the gas now? Is it variable cost or fixed cost? Variable cost. Why is variable cost? Because if I drive more, I have to pay more. If I drive less, I have to pay less. How about the insurance? What kind of cost is that? It's a fixed cost. Why is fixed cost? Because it doesn't matter if I drive my car or not, I still have to pay that cost. Make sense? If you drive 5 kilometers, you have to pay $1,000, let's say $1,000 insurance. If you drive 10,000 kilometers, $1,000 insurance. So how much you drive your car, it doesn't change the amount of the fixed cost. The total cost stays the same. Now, but if you drive more, what if you get to the accident? Well, don't get to the accident. That's too specific example now. That's out of the context here. But what if you get in the accident? Well, if you get in the accident, the ICBC is going to cover for the accident. Let's put it this way. That's why you pay insurance, so you can cover the accident. And they're going to give you a new car, which you can drive again. If they might write off your car, give you the market price, which market price is always above the residual value of your car. So I think you're going to solve the problem. You're going to be back on the road unless you have major injury, the way I had it, so you cannot walk. That's going to be the other thing. But that's not going to affect your insurance unless you are the one who caused the collision. Right? But I don't think the person who hit me and broke my leg, she's going to see any increase in her insurance. Why? Because she already get a ticket from the police for $167 for not yelling on the pedestrian crosswalk. She never going to get anything that she broke a leg of another human being who suffered for 3 months and is still suffering and cannot walk properly. Right? And those are the other things which she doesn't even care. Why? Because once she paid the $167, and don't forget she get 25% discount if you pay within 14 days. Right? But let's leave that one. That's too much now. Let's not go there. Let's go to some other example. Let's go to Whistler. Let's go to Whistler for ski. Have you been this year on Whistler? This winter season? How many of you have been there? Anyone? I know, right? That's super expensive now, but I was hoping at this. How about anyone being on where? Seymour or Cyprus? There was no snow, right? It's a bad example here. Yes, okay. Finally, Chris, how much you pay? Are you having pass or day pass, or you're just going there and you have the annual like a day pass? How much is day pass? $100, $60, $70? Let's say the pass is $100, right? Yes, okay. Let's go. Pass is $100. Okay. So, what kind of cost is this for you? Variable cost or fixed cost? It's a fixed cost. Why? Because once you buy the pass, you can go back to the car and go back to home. Did you use the ski pass? No. Why? I decided not to use it, but you pay for it, right? So what if you decide to ski? Okay, you're going run one. How much is the cost for that run? $100. If you run 2 times, what's going to happen now? Still $100, but how much is the cost per run now? If you run the slope 2 times, how much is now the cost per run? $50. So what's your incentive here? To run as many times as you can. Because that's the only way you to get the maximum benefits of the $100 that you pay. Correct? Makes sense? That's why you have, as you can, if you want, we can give you I can give you the example for variable fixed cost for the restaurant. Having a restaurant in mind, can you give me example for the restaurant with the variable cost and fixed cost? Which one will be good example as a variable cost, and which one will be good example for the fixed cost? McDonald's, what kind of cost will be that? If you're eating in McDonald's, what kind of cost will be that? Variable cost. No. We're talking about only restaurants. If you're eating in the McDonald's, it's variable cost, correct? How about, so if you want, if you eat what you eat, if you're still hungry, do you have to pay more? So now, if you go to the regular restaurants, like some, I don't know, any restaurant, noodle place, what kind of cost is the food? Variable or fixed? Gina, why do you think it's a fixed cost? It's a variable because if you finish the dish and if you're still hungry, are they gonna fill up the dish for you? Or you have to purchase new one? And when you purchase new one, that's gonna be more cost, right? When you purchase something, you pay. When you purchase something, you pay. When you purchase something, you pay until you say, okay, I'm done. Correct? Now give me example for the restaurant or place that you can eat where the food will be fixed cost. Think about it a little bit. All you can eat. Yes. When you go to the buffet, what kind of cost will be that? Fixed cost, right? It doesn't matter. You can eat as much as you want. You already pay for it. It's one price, eat as much as you want. That's why when you go into those buffet, you not, yeah, Korean barbecue. I know Korean barbecue. There's one Korean barbecue in Surrey, right? And you're going there, you're just eating as much as you want. Now you have to think about something else. Which one will be more beneficial for you? Because if at some point, yes, it's more you eating, it's paying one price. But now those buffets start charging too much. Now, when you go there, your intention is only to cover the cost. Means I have to eat at least that amount of food. Otherwise, it's not going to make sense. Correct? If you don't eat at least 3 course of meal, that is not going to cover the price. So at some point you're thinking, if I'm not so hungry, should I go to the buffet or should I purchase, I'll say, from the menu? Make sense? That's why sometimes it might be more beneficial instead of staying on the fixed cost, you to move on the variable cost. In some instances, you better move to the fixed cost because when you're super hungry and you have a need for 3 days, and you have a lot of space to fill, yes, go to the buffet. And then that fixed cost, you can use it as much as you can. You can even get a table close to the washroom and just going 3, 4, 5 times back and forth, back and forth, back and forth, right? You can do that. But if you're not that full, and if you think that with a small amount you're gonna get super full, then it doesn't make sense for you to go to those all-you-can-eat places. You better go to enjoy a nice meal and pay variable cost for what you eat based on your consumption, and you might be able to, your bill might be less. Make sense? That's how you should look at between the variable and fixed cost. And that's how you should differentiate variable and fixed cost. Again, fixed cost is something that you pay and then you can use it, where the variable cost is you using, you pay. You using, you pay. You using, you pay. More you using, more you pay. Less using, less you pay. Does that make sense? We're going to talk more about these costs in chapter 3, which will be next time.
Oh, Ivan, I have one question.
Yes, please.
So let's say you go to the buffet and you pay, and then so you already pay, you're there. Is that cost now a sunk cost? So it doesn't really matter how much you eat?
No, no. In that case, that cost will be fixed cost to trace to the amount of the food that you're eating. Make sense? So now the only way you to make that cost work for you is to eat more. So imagine this. If you don't go to the buffet, you know that you can eat, let's say, French fries plus chicken wings. And you know that I can eat 5 chicken wings and 1 French fries, and that's going to make me full. Now, if you go and order those one on the regular order, let's say 5 chicken wings, if you have to pay like $2 per chicken wings, that will be $5, $10. And French fries, $15, that's $15. If you have to order it separate. Make sense? So now you're going on the buffet and you're paying $65. Now the question is, with your normal consumption food or the intake of food that you have, are you be able to, for the $65, to make it work for you? Make sense? Yes, once you pay it, it's a sunk cost, no questions about it. But we're not making decision here. Because now our decision is, should I go to the buffet or should I go to the restaurant? Because if I go to the buffet, I have to pay fixed cost. If I go to the regular place, I have to pay variable cost. Variable cost means every time when I order dish, I have to pay. Where in the buffet, I'm dumping one amount of money and then I start eating. Make sense? So the sunk cost itself is for the decision making. But since we haven't paid that one yet, now we have to make a decision which restaurant to go. Make sense? Now, watch this. If we pay for the buffet and we didn't like the food, and then we decide to go to McDonald's, then what we pay for, then we're thinking, should I go to McDonald's, buy food from McDonald's or Kentucky Fried Chicken? Now, the decision between Kentucky Fried Chicken and McDonald's, whatever you pay for the buffet, now it's a sunk cost. That doesn't matter anymore. Make sense? So going forward, we're going to face this variable and fixed cost. Going backwards, we may have a sunk cost, but since we try to make a new decision, whatever already happened, it's already happened. That's in the past. All right. Interesting, good.